February 19th, Keith. We're back. How was your week? I hope you didn't get COVID or anything like that this week.
Well, funny thing you should say that, Andrew. I was tested positive on Tuesday and got the results Wednesday. But that was 2 weeks after my first symptoms. So you'll be pleased to hear, viewers, I am no longer contagious, but I have had it.
I can't believe I'm sitting in the same room as someone with COVID.
There you go. You're not.
Lucky we're on Restream. Lucky for the internet. Without the internet, where would we be, Keith?
It's one of the few good things about streaming. It protects you from the virus.
I think there are many good things about streaming. And another big week, Keith, in a lot of the themes we've been covering.
Yep.
Above all, Bitcoin. You have this really interesting lead editorial in the newsletter this week suggesting that the rise of Bitcoin might actually mean the decline of America. So once again, digital and geopolitics are intimately connected. What's going on with this?
Well, actually, the trigger for this article is a Financial Times piece written by Rana Foroohar, whose article was titled "Is the Rise of Bitcoin the Decline of America?" And it was all about the New World Order represented by the rise of China, India, and other places, the relative decline of the US, and the likelihood that the dollar won't be able to continue to play the role of a reserve currency. Her exact quote was that the rise of Bitcoin, quote, might be better interpreted as an early sign of a new world order in which the US and the dollar will play a less important role. And you know, that is a theme I've banged on about actually since my PhD thesis, which was about the decline of empires. And what I do say in the editorial is that this is an inevitable consequence of capitalism, that there's nothing, at least one part of it is. The rise of Bitcoin may not be, but the decline of the dollar is. And that's because capitalism, being the dynamic system it is, rewards those who invest latest in new technology.
But let's be clear here, Keith. The strength of the American economy and the centrality of the dollar in the international financial system, those are separate things.
They're not really separate things. I mean, yes, in the short term, I think you could make the case that in the short term, they're not correlated. But if you stand back and look at, let's say, the last 150 years and the role of the pound, and then with its decline, the gold standard, and then the rise of the dollar, reserve currencies or the reserves of the world are always held in what is believed to be the strongest instrument. And the pound used to be the strongest instrument, then gold was, and then the dollar was. Bitcoin, it could be argued, is becoming the strongest instrument. I wrote this editorial yesterday, and I said, as I write, Bitcoin is $51,752. But as I look now on our show here, Bitcoin is at $56,032. Not very many weeks ago, and this is a funny story for all of you guys, but not very funny for me. Not very long ago, I sold 2 Bitcoin and bought a Subaru Ascent for $42,000. 2 Bitcoins today is worth $112,000. So
you could have bought 2 Subarus.
I could have bought the same Subaru for only half the amount of Bitcoin. So I'm the fool in the room, not understanding.
Are you the only person, Keith, in Silicon Valley and Palo Alto driving around in a Subaru? Isn't that a bit embarrassing?
I have a wife whose dad had the same car for 20 years, and she holds me to account. She will not let me splash out on cars, and I think it's a good thing. One day I'm going to die, and she's going to need whatever money I've got left.
Well, I hope you leave it to her in Bitcoin. So one of the interesting implications of that, actually, thinking about this, is that people assume that Bitcoin's rival is the dollar. But if you look forward, perhaps Bitcoin's real rival is the Chinese currency or the Indian currency or even the Nigerian or Malaysian currency.
Well, I definitely think the Chinese currency, were it not for politics, would have a very strong case to be the likely replacement for the dollar. But the Chinese have understood very early that politics won't allow that to happen. And so they've actually are very advanced in creating a digital renminbi, which is a digital version of their currency. And it will probably exchange with Bitcoin at some rate of exchange.
But Janet Yellen's working also. I mean, every country now, the Indians are working on their own digital currencies. So why would they be just, why won't we see in the 21st century a digital Chinese currency, an American digital currency, an Indian one?
You will, but the way it works is if you take world GDP and you break it down by country, and you look at the rate of growth of the share of each country in world GDP, over the last 20 years, the American share has declined rapidly. The Chinese share has risen. If you measure GDP by something called producer price parity, China's already bigger than America. It's actually smaller in just pure absolute terms, but not by much. So, if there were all these digital currencies reflecting the share of world GDP, which is a proxy for the strength of each economy, China would be a rising star and America would be a declining former star. And now that's not necessarily a bad thing. Look at the UK. The UK still plays a big role in the world, and its decline kicked in over 100 years ago. So it's not like something to fear. It's just a reality of the way capitalism works.
What I liked about your newsletter this week is that you broaden the concept of assets. Bitcoin is, of course, a financial asset, but you're thinking now of news and information as an asset, and you analyze that in terms of this standoff between the Australian government and Silicon Valley giants like Facebook and Google. How is news or information an asset, Keith?
Well, an asset is something you pay for. And Google just agreed to pay News Corporation for its news. And that's the first time that a major internet company has agreed to pay an old world publishing company for the asset called news. Facebook, by contrast, has refused to do so. And this all goes to a new law in Australia that is forcing anyone that operates in Australia digitally to pay for news.
It's a fascinating story, I think, a really, really important one in terms of other governments' relations with Google and Facebook. And what's really intriguing to me is why Facebook and Google are dealing with the Australian situation so differently. You have another link in your newsletter this week to the growing conflict, a great power struggle between Facebook and Apple. But doesn't this suggest that the real conflict now is between Google and Facebook in their approach to how to deal with governments like Australia who are demanding compensation for links?
It is really interesting. I must just acknowledge that I don't fully understand why Google has agreed to do this. My familiarity with links goes back to the start of the internet when the nephew of Robert Maxwell, the former newspaper owner of the Daily Mirror, walked into Siberia Cafe, which I was the co-founder of, and offered to pay us for putting links on the screens. And I looked puzzled and said, why would you pay for a link? And this was a long time before cost per click came about. Many years later, not very many, but a few years later, I created a company called Real Names, and we sold links to the owners of brands, and we persuaded Google to let them come at the top of search results, and we got paid every time they got clicked on, well before Google was being paid for links. So links are valuable to the receiver of the traffic. Now, weirdly, what Google's just agreed to do is to pay the receiver of the traffic when the traffic itself should be the reward. And therefore, I wonder why they're doing it. I don't actually understand it. I'm much more...
Well, the understanding is that if they don't do it, then they don't have access to the Australian market. Then they're thrown out of Australia. And the French have been talking about this, and the Spanish for years.
Yeah, and Facebook's decision is the opposite, and I'll put the quote up because it's a well-written quote. This is Facebook's response. They say, in fact, and as we have made clear to the Australian government for many months, the value exchange between Facebook and publishers runs in favor of the publishers, which is the reverse of what the legislation would require the arbitrator to assume. Last year, Facebook generated approximately 5.1 billion free referrals or clicks to Australian publishers, worth an estimated 407 million Australian dollars. For Facebook, the business gain from news is minimal. News makes up less than 4% of the content people see in their news feed. This legislation seeks to penalize Facebook for content it didn't take or ask for. So I'm kind of aligned with that. That rings true and makes sense.
Yeah, I'm not surprised on that. I mean, I can see both arguments. You can argue that Facebook, it's all very well for Facebook to make that argument, but Facebook wouldn't have a product if the news companies weren't creating news which their users could trade on. Perhaps rather than the Facebook paying, it should be you or I posting on Facebook. We're the ones who really should be paying.
Well, I think even that's wrong. Think of the New York Times, who, by the way, have shown how to play this game. The New York Times sees links as traffic, and so it wants its links to be as widely disseminated as possible. And when they get clicked on, it wants to limit.
Yeah, but there's a bit of a difference then, and because the New York Times content is behind a paywall, although the Murdoch stuff's behind a paywall too. So the whole premise is if you're behind a paywall, what you're really doing is sending these companies potential customers. Because it's like with the FT link, you may put that FT link of Rana's piece, but anyone who clicks on it isn't a subscriber, is not going to be able to see it, and they'll be charged $30 a month if they want to take out a subscription.
Yeah, we can show it. Look, if I click on her link, which is here, it'll take me to the FT where I am logged in. Therefore, I can read it. But if my readers click there, they'll get a couple of free things to read and then be encouraged to subscribe. And that is the business model for news now. It has to be.
Yeah. And I mean, what's interesting to me is these companies and these governments are still arguing. You know, I've been writing books on this stuff for years. I mean, 10 or 15 years ago, the French and the Spanish were threatening to do this with Google, and now the Australians are. And what's interesting is why Australia, of all countries, is pioneering the challenge to Silicon Valley giants. Maybe because they can do. Maybe it's I don't know enough about the politics, the domestic politics of Australia.
No, I think it's not just the politics. It's the success of the New York Times and the Guardian and the Daily Mail means that news reading is global now, and local news is as much the victim of the Guardian, the New York Times, the Daily Mail as it is of the internet.
Yeah.
And so they're trying to protect, it's protectionism. They're trying to protect a failing industry within their own borders.
Well, I wouldn't quite put it in those terms. They're trying to support local journalism, which I think everyone would agree is still good in terms of democracy and the benefits of towns and cities and small and villages. So I'm not sure. I mean, you're not a hardcore Friedmanite libertarian. You don't believe that the market is always right and there's never any reason to subsidize anything. Surely you don't believe that.
Well, I don't use the word right and market in the same sentence. You're right. The market is the market. It does what it does. And one of the things it's done is reduce the asset value of news. You know, the total amount of money that used to go to news has shrunk massively.
Well, what it's done is reshape that, because it's taken away the advertising revenue of newspapers. They had to debundle their product, but it does allow high-end, very high-quality products like the New York Times or the Post or the Murdoch papers or the FT to sell subscriptions. So they're recalibrating their business model. Yeah. It's interesting, and again, SPACs are back in the news, talking about another asset class and another struggle over what is or isn't valuable. What's the news on SPACs this week, Keith?
Well, there's broad news about startups, and SPACs represents, the late stage of startups. CNBC had a piece. SPACs used to be a joke in Silicon Valley. Now they're going mainstream. And if you click through and look at that, it's an article that quotes Roger Lee from Battery Ventures, a good friend of mine actually. Hi, Roger, if you're listening.
Or watching.
And it makes the point that every VC fund, Coastal Ventures this week launched 3 SPACs. Every VC fund that has investments in companies that are now late stage, rather than kind of casting them off into an IPO, can go and raise money for a SPAC and provide a landing place for those companies that also makes money for the VC fund. And so that's what they're doing. They're basically trying to own late stage transition.
So it's do-it-yourself IPOs, essentially.
It's a do-it-yourself IPO.
I mean, and what happens to once you have a SPAC, you don't need to do an IPO, is that right? Will it actually, if it's successful, will it eventually kill the IPO market?
Yeah, it's a replacement for an IPO because you are actually going public through a different mechanism. You're merging with a SPAC, which is already public, and by merging with it, you become public. So that's the first story. The second story is called Dreams All the Way Up, and it is about whether or not there's a bubble in the valley, and this is driven by the fact that Robinhood could raise $3.4 billion over a weekend.
Yeah, but that was an exceptional situation, wasn't
it? Well, less exceptional than
that was existential for Robinhood. Otherwise, they would have gone out of business.
Yeah, but the article actually goes into lots of other examples of companies being able to raise very large sums of money, and the reason for that is that the public markets, as we've talked about previously on the show, from an article by the Red Point Ventures guy, Thomas Tungers. The public markets are now paying very high multiples for growth companies, which means that you can get 20 to 30 times your annual revenue as a valuation. Therefore, companies are raising lots of money, then either doing a SPAC or doing what's called a direct listing, both of which are IPO replacements. And it's just happening more and more and more, and the sums are enormous.
And of course, most of all, the market that's being most profoundly transformed or disrupted, to use a TechCrunch phrase, is fintech, or the financial markets. The traditional bank. We talked last week about the end of conventional retail in banking. I mean, the SPACs, Bitcoin, it's all bound up with the same profound shift in asset value from traditional banks to all sorts of new companies, from PayPal and Square to the Bitcoin companies and other blockchain companies.
Right. It's what I do in my day job. In my day job, I work with CEO founders, helping them tell their story to investors. And the art of telling a story is exposing the future value of the asset and getting somebody to pay a fraction of that today.
So okay, so I get that, Keith. So if you were tutoring the guys at Clubhouse, which maybe one day you will, what's the story they need to tell? Is this a bubble or for real? And what's their real value? You have some stuff on Andreessen and Clubhouse, so it fits nicely into our next segment.
Yeah. The whole section's about the changing in the media. It starts
two big media guys. They used to be VCs, now they're media guys, Horowitz and Andreessen.
Yeah, I predict failure for them in being media guys, to be honest, but they're trying.
Well, Horowitz didn't do a very good job. He used the R word on Clubhouse that got him into trouble, didn't he?
What's the R word?
I'm not allowed to say it. You have to look it up. I didn't know it when I read about it.
I'll go and look
it
it
up. Someone from the New York Times reported on him, and it caused a big controversy.
So yeah, Ben Thompson from Stratechery, as I pronounce it. Apparently, that's not the American pronunciation.
He's a good writer. I think
he's a very good writer. He's got an article called "Clubhouse's Inevitability," and then there's a thing all about Google Spaces, which is Twitter Spaces, which is Twitter's Clubhouse competitor. How Twitter got its groove back, and various other things all about the media. But Clubhouse, if I was advising Clubhouse is a media company. It is going to get money from selling content. It will either sell it via tickets or ads. I suspect tickets, subscriptions. So when you and me go on Clubhouse, people will pay, $1 to enter the room. 5,000 people can enter, and Clubhouse, out of the $5,000, if it's full, Clubhouse will probably take it.
Right. So in the midst of all this disruption and new concepts and SPACs and Bitcoin and all the rest of it, the business models aren't changing. Either you pay for the stuff or you get your revenue from advertising. So there's nothing revolutionary about Clubhouse. Well, all it's done is created an infrastructure for many-to-many audio.
Live many-to-many audio.
And it's got somehow maybe because of the Andreessen Horowitz connection, it got a lot of heavy hitters to get on it, to give it credibility.
Everyone's on it now. I mean, it is a deluge of name brand talent, and I still believe that it's an open question whether it survives and gets huge or not. But there's certainly a path for it to, which is owning live audio to audiences that pay to be part of the audience. And I think if you were to model that out and do a deck, which is what I'd do with them if I was working with them, you would look at the future value of those audiences, and you'd get investors to give you a fraction of that future value today to benefit from your growth over time.
But the thing with, at least my sense of Clubhouse, is my experience on it, it needs to be somehow curated and searchable, because otherwise it's just a mess. And the stuff I've listened to is so, it's the opposite of Twitter. It's so boring. I mean, Twitter's not boring, but it's just outrageous and aggressive and unpleasant. But Clubhouse is the reverse.
Yeah, if the two of them had a child, it would be a bit more interesting, which is probably what Twitter Spaces is going to be.
But if you want to, for our listeners and viewers, if you're having trouble sleeping, go on Clubhouse. What are our startups of the week, Keith? We've got 2 this week.
Yeah, we've talked about one of them before, which is UiPath, and so we'll just briefly mention that UiPath is now at a stage where it's early investors, and going back to the whole theme of asset value, the early investors bought into UiPath, and they are now at 220,000% return.
Is that more than Uber?
Yeah, way more. Yeah,
that's the biggest in history. So it means if you put $10 in, it'd be worth $2 million now.
It's even more than Airbnb, which is also very big. But the other startup of the week is Waze, and I chose this one because one of the founders of Waze,
startup, should we say Waze, because it got acquired.
They were acquired by Google, but Noam Bardin, you shared this with me, Andrew, and brought my attention to it. He left Google this week, and he wrote a long, very thoughtful piece about the history of his decision to sell to Google. And it's a very, very honest rendition, which includes hatred of his board of directors and investors, and a desire to swap bosses. He thought Larry and Sergey would be better bosses than his board of directors. So it was an acquisition driven by the desire to escape from ownership of the asset by bad owners. It's really a great read. He's very honest. It's long, by the way, as you can see, but it's really, really good.
Like Waze.
Crowdsourced,
but this guy is an Israeli entrepreneur, right?
I believe he is, yeah.
And our tweet of the week, Keith?
Our tweet of the week is our friendly South African entrepreneur, Elon Musk, is being talked about by John Pompiliano. And the tweet is acknowledging that when Elon made 180 million from selling PayPal, he spent all of it. 100 million went to SpaceX, 70 million to Tesla, and 10 million to Solar City. And he had to borrow money to pay his rent afterwards. It's now multiplied 1,000x to 190 billion. And the point is, the greatest entrepreneurs are not driven by money. Money is just a byproduct of their success. And
well, it's certainly true of Musk. I mean, clearly he's driven by many other things, excusing the pun, driven. But, you know, the funny thing is, if he'd have kept the 180 million he made in PayPal, it probably would be worth 190 billion now.
It could easily be. Although I will tell you, when I hear pitches from entrepreneurs, if I detect, I've got to go on a call, so we've got to wrap up. But if I detect that they're interested in money, it turns me off.
Well, no one wants to turn Keith off, although we're going to have to turn you off now. You've got to take your call. Yeah. That was the week for February 19th, 2021. Things are back to normal, Keith. No talk of the T word, nothing about riots in America. We're back to hardcore tech and SPACs and Bitcoin. Long may it continue. I wish you a very good recovery from your COVID experience, and we will see everybody next week. Keep well, everyone. That was fun. Thank you.
And I'll come. Hey, Andrew.
That wasn't bad. I mean,